Ladies and gentlemen, good day and welcome to Solex Energy Ltd Q1FY27 post-results earnings conference call hosted by Adfactors PR. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, you may signal the operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. And now in the conference, over to Mr. Rushabh Shah from Adfactors PR. Thank you, and over to you, Mr. Shah.
Thank you. A very good morning to everyone and warm welcome to Q1 FY27 earnings call of Solex Energy Ltd. From the senior management, we have with us Dr. Chetan Shah, Chairman and Managing Director, Mr. Vipul Shah, Non-Executive Director, and Mr. Hemal Kachiwala, Chief Financial Officer. Before we begin the earnings call, I would like to mention that some of the statements made during the call may be forward-looking in nature, and hence it may involve risks and uncertainties, including those related to future financials and operating performance of the company. Please bear with us if there is any call drop during the course of the conference call. We would ensure that it is reconnected at the earliest. I now hand over the call to Dr. Chetan Shah, Chairman and Managing Director, for his opening remarks. Thank you, and over to you, sir.
Thank you very much, and hello to everyone. Very good day to all of you. On behalf of Solex Energy Ltd, I welcome all our investors, analysts, and stakeholders on this call to discuss our Q1 FY27 results. Let me begin with two developments that I am happy to share with you. First, we have completed our listing on BSE Limited. Solex Energy is now listed on both the NSE and the BSE. Kindly note, this was a listing of existing shares on the BSE main board. No fresh capital was raised. This is a milestone we are proud of. It reflects the confidence that investors and stakeholders have placed in our vision, our governance, and our long-term growth strategy. As of today, Solex Energy is supported by a growing community of over 11,000 shareholders. And with our presence on both exchanges, we look forward to further broadening our investor base, improving liquidity, and strengthening our shareholder profile. Second, the company continues to strengthen its order inflow following a 628 plus crore order received in July 26. In August 26, secured 42.47 crore new work order from a domestic private limited company in the power sector for the supply of N-type top 620 watt peak class to class solar PV modules, with execution scheduled to commence in October 2026. In addition, the company has received LOI for further 175 crore order with MSA currently at the signing stage. Together, these orders represent an executable order pipeline of 845.84 crore targeted for the execution by the December 31st, 2026. Before I take you through the quarterly performance, let me place Q1 in the right context, because I believe context is important for how one reads these numbers. As we consistently said in our previous interaction, our business is closely linked to utility scale solar project execution in India, and it is inherently H2 weighted. The first half of the fiscal year is seasonally softer, and the second half is when the bulk of module dispatches, EPC completion, and the revenue conversion happens. Q2 FY27 has unfolded along that same seasonal shape. There are four factors worth highlighting. First, ALCM, which is known as ALLM2, production flow, higher operating expenses, shifting of delivery schedules. Consequently, customer offtake of modules slows down in Q1 and Q2, and the pipeline flows into H2. This is a structural feature of our industry, not a one-off. If you look at Solex's own trajectory over the last several years, the pattern of the softer H1 and much stronger H2 has been consistent. Second, ALMM. As you are aware, up to the middle of May, there was a broad expectation across the industry that the ALMM List 2, that is ALCM, timeline on sales would be extended. On 25th May, it was clarified that there would be no extension. In the weeks that followed, a number of upcoming projects were placed on hold, and the market as a whole moved into a wait-and-watch mode while developers assessed the implication of their project timeline and their financing. This slowed down the press decision-making and led to some customer-driven rescheduling of module deliveries during the quarter. I want to be very clear on 2 points here. These are the timing shifts and not cancellations. And we do not currently see any orders as risk. And whether ALMM is extended at any stage or not, there is no impact on our order book because we are prepared for both scenarios. For ALCM compliant order, we have supply arrangements in place with domestic cell manufacturers, and for our other orders, we are fully secured on the imported cell supply chain. Third, the cost base. With softer volume in seasonally weak quarter, our fixed cost and the full quarter impact of depreciation and interest on our 4 gigawatt capacity are absorbed over a smaller revenue base. Let me now turn to operations and order visibility, where I would like to focus most of your attention. Our 4 gigawatt module manufacturing capacity at Tatkeswar, Gujarat, continues to operate as planned. The ramp-up of Line 3 and Line 4, which were commissioned in November 25 and reached full utilization by March 26, is now well behind us. For financial year 27, we are working with an average utilization assumption of around 55% across the year. On order book visibility currently stands at approximately 3,400 crore. This is spread across the 3 stages: confirmed purchase orders, where deliveries are underway, signed MSAs, where formal POs are awaited, and MSAs at the advanced stage of discussion. As I mentioned earlier, this visibility is not contingent on an ALMM outcome, or that is ALMM 2 outcome. Alongside this, we continue to see healthy inquiry pipeline from both existing IPP relationships and new customers. And we keep adding new orders even as we execute the existing book. Our customer profile, which includes several of the largest IPPs in the country, is a source of strength and not a concentration risk. These are the most quality conscious buyers in the industry. They conduct their own pre-dispatch inspection and repeat business from their cohort has been the foundation of the Solex order book. We remain aligned with the FY27 revenue guidance and PAT margin in the range of 5 to 6%. Let me now touch on the strategic priorities that we are executing in parallel with new term delivery. Technology and manufacturing differentiation remain at the core of what Solex stands for, and we were the first Indian manufacturer to launch G2L TOPCon module. Our facility is fully automated and MES driven with complete unit level traceability, and our in-house testing laboratory allows us to certify products against the most rigorous international climate conditions. Our R&D partnership with ISC Constance, Germany, continues to progress on the next generation back contact and TOPCon Plus cell roadmap. And our engineering collaboration with the TT Vision Malaysia is helping us on automation and process optimization. These are what allows us to serve the IPP and CNI segment, and they are the reason our customers come back to us. On cell manufacturing, our roadmap is intact. The 2.2 gigawatt N-type TOPCon Plus cell line, which is the first phase of our planned 5 gigawatt cell capacity, is on track for commissioning by end of calendar year 2027. On land, we are in closing stage of the identified parcel with connectivity approvals expected shortly. On funding, the debt component of the approximately 700 crore is at an advanced stage of discussion, with our lender, and the equity component of 350 crore structured as a combination of NCDs and CCDs is progressing through the due diligence stage. We are also onboarding an experienced top-end cell manufacturer on a KPI-linked basis for line design, commissioning, operations, which significantly de-risk the ramp-up phase. I want to be clear on one thing. Cell manufacturing is not an incremental capacity for Solex. It is the platform on which the next phase of our margin trajectory is being built. Once operational and stabilized backward integration into cell is expected to support a meaningful uplift in profitability over the current range, investors should see Q1 as the near-term operating cycle and cell manufacturing as a medium-term earning inflection. On BESS, that is Battery Energy Storage System, we continue to progress on our evaluation with the technology partners identified for the containerized BESS manufacturing setup. As shared previously, BESS will be housed in a separate subsidiary. We will come back with more specifics as the plan firms up over the coming quarters. All of this sits within our long-term visibility Vision 2023, under which we intend to build 10 GW of module capacity, 10 GW of solar cell capacity, 10 GW of BESS infrastructure, and 2 GW of wafer and ingot capacity, while exploring further integration across the solar value chain. This is closely aligned with the Government of India's Atmanirbhar Bharat and Viksit Bharat initiative. And the rupees 4,000 crore MOU we have signed with the Government of Gujarat is the first concrete step in that direction. To close our operating priorities for the remainder of FY27 are straightforward ramping utilization across all 4 module lines, converting the advanced stage order book into the confirmed POs, closing out land, funding, and technology approvals on the cell project, building the export footprint, and preparing the balance sheet for the next capex cycle. Solex has always taken a calibrated approach to growth. We announce capacity when technology, customer relationship, and funding are in place, and we deliver on what we announced Q1 FY27 at the start of the H1, H2 curve we have consistently spoken about. And we remain confident in the shape of FY27 and in the medium-term opportunity in front of us. With that, I now hand over to our CFO, Mr. Hemel Kachiwala, to take you through the financial performance in detail. Thank you.
Thank you, Chetan, sir. Good day to all. Let me briefly walk you through the financial performance for Q1 FY27. For Q1 FY27, total revenue stood at 265.6 crore as compared to 261 crore in Q1 FY26, a growth of 1.8% year-on-year. EBITDA for the quarter stood at 33.8 crore as against the 42.7 crore in Q1 FY26, translating into an EBITDA margin of 12.7% for the quarter as compared to 16.4% in Q1 FY26. Below the EBITDA line, there are 2 further items to note. Depreciation and amortization for the quarter was 10.2 crore as against 4.3 crore in Q1 FY26, reflecting the full quarter impact of line 3 and line 4, which were commissioned only in November 25. Finance cost for the quarter was 12.5 crore as against rupees 5.4 crore in quarter FY26, reflecting the higher working capital deployment during the quarter, and the fact that a larger share of our working capital requirement was met through fund-based limits rather than non-fund-based facilities. Together, these 2 items account for a significant part of year-on-year movement at the profitability level. Profit before tax for the quarter stood at 11.1 crore and PAT stood at 8.3 crore in Q1 FY27 with a PAT margin of 3.1%. Earning per share for the quarter was rupees 7.39. To summarize, the year-on-year movement at the profit level reflects seasonally softer volumes and the full quarter impact of depreciation and interest on our expanded capacity, and not any change in the underlying business. Our order book, our customer relationship, and the balance sheet position remain intact. With an H2 weighted execution calendar ahead, we remain confident of delivering on our FY27 guidance. With that, we now open the floor for the questions. Thank you.
Thank you very much. We'll now begin the question and answer session. Participants connected on Zoom app may click on the raise hand icon to ask your question. Kindly turn on your audio, announce your company name, and proceed with your question. Anyone connected on the audio bridge may press star and 1 to ask a question, and you may press star and 2 to remove yourself from the question queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from Rishi. Kindly announce your name, your company name, and proceed with your question.
Hello.
Yes, Rishi, go ahead.
Yeah, hope I'm loud and clear.
Yes.
First of all, thank you for the opportunity, sir. My first question is, in November, you referred a total capex plan of 1,500 crores, if I'm not wrong, or 1,100 crores in cell line, 200 crores in module, and 100 crores in working capital. This was funded by 1,000 crores in debt and 500 crores in QIP. But in May, the reference has changed from 1,500 crores to 21050 crores, from 700 crores via debt and 355 from equity. Sir, just want to know what made this change and which figure should investor community use for their reference in FY27 modeling?
So, Rishi, this this vision was there when we were planning for adding an additional 2.5 gigawatt of module line. So, looking to the current market dynamics, we have planned to not to go with the additional module capacity, because we foresee that a lot of module capacity will be available in the market as and when Solex requires. So that's almost 200 and odd crores has been reduced because of no urgent capex plan for the module line. Plus, while working with our vendors and our team, the project cost is around 1,050 crores. So at present, 1,050 crores, out of which 700 crores from the principal lenders and 350 crores will be our margin. So at present, you can consider 1,050 crores for the 2.2 gigawatt of cell line. That is the immediate expansion plan.
Understood, sir. Understood. And sir, one last question, that inventory grew significantly in FY26. So it's from 1795 million to 2905 million approx. So alongside the finished goods pile up you have discussed, is there any risk of inventory obsolescence or write down given by the pace of module technology change?
It is like we said, it is a seasonal impact, but the technological change is not an impact because we have the latest generation of modules manufactured by us, mainly the G12R. So this is the seasonal impact and all the inventory. So last year also, if you see the same pattern was continued, and similarly in the current quarter, the current half year, the same thing is going on. So maybe with the once the monsoons are over and the fields are ready for installation and everything, this all inventory pile up and everything will go. And again, this is the reason you see the first half and the second half, the huge difference. So almost if you see the Solex trajectory, the difference is 1:3. That is the huge gap and the way Solex is being performed.
Understood, sir. Understood. Thank you. That's all from my side.
Thank you.
Thank you. Next question is from the line of Mandira. Kindly announce your company name and proceed with your question.
Thank you for the opportunity, sir. This is Mandira from Investo. Couple of questions from my side. So, with India's BESS order pipeline at around 50 GW is expected to award over next 24 months, so which is likely to double the addressable solar market size. So, what gives Solex the credible right to win despite having no manufacturing track record?
Yes.
Yeah. So I think BESS is something which is a quite exciting journey in India. And basically, currently there is a dependency on import of technology in BESS. In India, also those who are setting up the BESS manufacturing currently, they are much more dependent on the import of the whole technology. And so basically, Solex has already announced the BESS expansion, manufacturing expansion. In fact, so it's total 10 gigawatt, which we'll do in two phases, 5 plus 5. So we have already started evaluating technology and then, on a multi-front for BESS. And we would like to catch up this BESS journey also, Indian BESS journey, and not only Indian, but overseas BESS journey also in days to come. So at present, there are very few manufacturing setup for the BESS in India, and which are just on a trial basis. Those projects which are already awarded, in fact, they have their own timeline to finish their and commission their projects. So we'll be able to catch up this journey, once we reach to that stage of going for the, adding the BESS to the existing plant or the new plant, upcoming plant.
So, Mandira, to add on what Chetan bhai mentioned, like if you have seen the Solex journey, we closely work with top-notch tier 1 manufacturers, solar manufacturers in China. So same approach was there in the module line. As Chetan bhai mentioned, we are technologically tie-up with one of the most reputed cell manufacturers in China. So same thing will follow for BESS also. So we are in the advanced stage of discussions with what technological partner we have to onboard and how the entire setup is to be done. So as and when things are there, so we are not going to just jump in the BESS, seeing the the opportunity and everything. But whenever we do, it will be very deliberated.
Got it, sir. That's great. So secondly, how does your cost structure and the product quality when it is compared with the Chinese competitor in the targeted export market, and particularly given that India's higher revenue module is there in ASPs?
Are you referring to solar module or you are referring to BESS?
Solar modules.
Okay. So basically, Chinese are, otherwise they have their own business strategy and they are very aggressive in the overseas market. And so basically, Solex is finding place where there is some preference for the Indian module manufacturer. So we go very strategically in a marketplace where there is a preference for Indian module. Indian modules are not that bad in terms of pricing. We are competitive, but yes, Chinese strategically they place prices in such market where it is very difficult to compete with them. But yeah, as I say, we focus on a market where there is a preference for Indian modules. Otherwise, in terms of scale of economy in India and overseas, in terms of quality, I think the Indian modules are at par with Chinese, and sometimes the Indian modules are better proven in terms of quality and reliability. It is just a strategic placement of pricing and the grants which are available for the overseas market for the Chinese manufacturers, which is now, the Chinese government is removing, so the real competition will, and the real situation from the Chinese price will come in front in few quarters now. And so our focus is majorly, as far as the overseas market is concerned, it's the Middle East, Africa, Europe, and we are trying to establish on US market as well. But currently we have majorly focused on Europe, Middle East and Africa, other than India.
Mandira, but in our projections, the export revenue is on a very lower side for the FY27. So we are making our present felt, and we have identified a full-fledged team to represent Solex in the European market. So as and when the right opportunity is there, Solex will be ready to grab that opportunity.
Got it, sir. All the best for the coming quarter. This answers my question. Thank you so much.
Thank you, ma'am.
Thank you. Next question is from the line of Manan Shah. Kindly announce your company name and proceed with your question.
Yeah, hi. Manan here from Moneybee. Thank you for the opportunity. Sir, historically, we've seen that Q1 is not as weak as we have performed this quarter. So what resulted in such a weak performance in Q1 despite, having so much capacity available?
So as we mentioned, Q1, the entire line 3 and 4 was operating. So all the interest, depreciation, and these expenses were there. Comparatively, revenue was not to that side. Secondly, there was some EPC government revenue, which was booked in the first quarter of 26, which are not here because Solex has stopped doing we are taking very government projects on a niche basis or very selectively. So these
No,
are
I went on the module side. Generally, April, May, and June, this time monsoon was also delayed. So I would have assumed that execution would have been stronger versus what we've reported in general. So
because of ALM, announcement of ALM 2.
but our orders were outside of ALMM, right?
No. So there was a mix of ALM and so people slowed down, Manu. So what people have done, they've seen the 1st June was a very tight schedule for people to implement. Suppose if my solar farm is ready and I don't get connectivity from the grid because of any reasons on the part of grid, then the whole project will be in problem. In fact, if you see when the government announced and then they have given a limited window for people those who have stuck. So I think so some 4,000, 5,000 applications were received whereby the project was stuck because of 9,500 applications were received where the projects were almost on the ready stage or the majority of modules and everything were delivered. So this was, the industry did not have clarity. Secondly, people were not clear whether they have to buy the ALM compliant modules or the non-compliant. So what people thought is better to wait and watch. So now with the clarity that government has given selective extension, people have got clarity and the orders are getting converted. In fact, so a lot of orders, they'll hold the delivery, what Chetan Bhai mentioned, that deliveries were hold. Also, the orders are not cancelled, but they are extended. So I think so, you will see in the second half, we'll be able to cover this number. So maybe
I'll add to, I'll explain the situation, like the order situation. There are orders which are already grandfather projects. Like, so the ALCM impact, the ALCM mandate doesn't impact on those orders. What you're writing on them. Those orders are the H2 orders or delivery and to be converted in revenue. Because the post-monsoon only they execute the project. These are the utility scale projects. Another set of orders are the captive projects where there was a lot of confusion because of the ALCM. And then due to that, there was a deferment of a delivery schedule and timing and everything. Because the mandate came with the immediate effect without having any timeline, and then the government landed up to into the 9,500 applications for the commissioning and the granting them extension. So with that background, government, in fact, they've extended this till the month of December for the commissioning. So meanwhile, the announcement came in mid of July. So that was a full-fledged monsoon season everywhere. So those who are granted extension, they are now waiting for the monsoon to get over and execute their projects. So basically, this situation is with everyone. So the situation will be improved once the monsoon gets over, and then there will be a lot of pressure in execution of projects and delivery of a module for both the segments, the other projects and the captive and those who are granted extension for time. Such a time.
Okay. And out of your order book or pipeline that you say of 3,500, how much of this can get impacted by this ALMM 2?
Majority of are the grandfather projects, and almost about, you can say, 20% of orders will be which are having the vulnerability from this segment. But now because of the extension, that problem is also solved.
Okay. And you also mentioned in your commentary that you have tied up with some cell manufacturer, if at all this ALMM gets implemented. So can you highlight with whom have you tied up and what sort of arrangement it is that ensures guarantee of cell availability to you?
Yeah. So we are already working with 3 cell manufacturers in India, and we are buying domestic manufactured cells from them for the DCR supply, which is at very smaller volume right now. And we have signed MOU with a couple of upcoming cell lines. They are likely, one of them they have, because I am unable to announce the names because of the NDA which I signed with them. And, so we have to work with the multiple cell manufacturers. One of them, they have already started, partially they are operational and they are on a ramp-up phase. Once they complete the ramp-up phase, they have already committed 1 gigawatt of cell supply per annum to us. And there are 2 other manufacturers, they are already on the verge of starting their production line. So I think once we are done with, we will, whatever I'm trying to say is that last quarter of this financial year, we'll have a clear visibility for the domestically available cells, because right now we are totally tied up with the grandfather projects. And so we have a limited space available for to take on the DCR mandated projects right now. So next year we will have a sufficient supply where there will be a majority of these projects will have a DCR mandate, and we will have a sufficient supply from those with whom we have signed the MOUs, and with the quantity of almost about 2.5 gigawatt of cells per annum. And these are all like the G12R cells. Currently, G12R cells are not available, and those with whom we signed contract, they are producing only G12 cells. They are converting their production line to G12R. Once the conversion happens, then we will have a supply.
And also the FY27 majority of revenue is coming from the non-DCR, so non-ALMM listed. So at Solex we will require mainly DCR cells from April onwards, so April 27. And we believe at the time our requirement will be there will be a lot of capacity available in the market, because a lot of lines are in the installation phase and on the ramp-up phase. So till the time Solex requires DCR module, lot of cell availability will be there in the market.
Okay. And also in your commentary, you mentioned that you have confirmed POs of around 800 to 900 odd crores. So is this the execution that can be expected till December? And how do you see the balance order book getting converted into PO?
These are to be executed by the December this year.
Right. But from your inquiry pipeline, is there a possibility of further orders getting converted into PO till December, or this is the execution that you are expecting will happen?
These are the orders we have already closed it, and that's the reason we have mentioned here. There are many orders in the second, because if you remember, I mentioned the different phases of orders, and so there are MSA already signed, and then we are waiting for the timeline and backed by the from PO. So these are the orders which we'll announce once we keep closing one by one.
Okay. And any update on our cell line project? Because we have been talking about closing the land deal for the past many quarters, and also the funding arrangement. Still there is no any conclusion on either of them.
So there are 2 answers. One is that land we have already procured, and we have applied for the electricity connection in Gujarat. It has its own time because of the availability of, there is a huge requirement for the electricity. We have applied for 30 megawatts of connection, and then we are waiting for the government to give us in writing. In principle, verbal approval is already done. We are waiting for the written approval. Once we have a written approval, then we will have all other documentation in process. And so that is one part. Second part is the changing in strategy, because initially our planning was to raise equity through the QIP and pref round, but then the market situation is not something which is favorable for this round, and then we have changed to the structured date. And for to raising this through this route, the due diligence and everything is completed, and the matter is at the final stage of evaluation with the investors and the funding agency. So these are the two major factors where, we are taking a little bit more time than what it was expected. But I think we are on track, and our preparation and homework is such that we will ensure that whatever that time we have consumed on this phase, we will overcome in terms of for the execution, because almost everything is designed, the agencies, everything is aligned. We will announce everything once the finance closure is done, and then we get a confirmation from the electricity connection. These are the two major points that we want to close before we openly come in the market and with our announcements and the time schedule and then to whom we are working and everything. Thank you, Manan.
Okay. I just have one last question, if you may permit.
Good.
Yes.
Yeah. So, initially we used to talk that we would be manufacturing for the world and not only for the Solex brand. So are there such opportunities still available in the market, or those opportunities have dried up because, our utilizations are fairly low, and or is there a shift in strategy now that we will only manufacture a Solex brand? Or
Yeah, so it's a good question. In fact, the facility which we have designed and then, we are operating, which is as per the global standards. And in previous year, we have already manufactured for the the world number one brand. So we are already in a discussion and on a agreement stage with the other brands also, and, we'll manufacture for them. These are all will be the Solex branded modules, for their clients. So basically, in India, those foreign brands, they cannot sell in India because they don't have any manufacturing facility of their own. And so they cannot sell with their own brand. So they have adopted Solex brand, and likewise other companies are also in discussion, and they are waiting for the confirmation and on the timelines and everything from the client and from our side as well. So this journey is on, and it's a very, because we have already done for two companies which are the globally top 5 companies, and then with this past track record, the other companies are also quite open for us. As far as the OEM contract manufacturing is concerned about the global brands, we now basically, we are focusing on that segment as well. Up till now, because our capacity previous year, our capacity was limited. The capacity got expanded in December, and then it was backed by the orders. Now we do have some visibility for taking the contract manufacturing orders also from the global brands. So we will look into those segments also, because currently up till December, we don't have any visibility to take such tasks because it's all backed by the existing orders. And Q4, we will evaluate whether if we are able to close complete capacity, available capacity with the domestic orders, then we'll focus on the contract manufacturing in the next financial year. But yes, for the Indian projects from the global brands, we are already discussing. We are likely to close something for the Q4 for the Indian projects from them.
Okay, sure. Thanks. I'll get back in the queue.
Thank you very much. Next question is from line of Bhavya Agarwal from Share India Securities. Please go ahead.
Hi, sir. Good morning. Am I audible?
Yes, go ahead.
Yeah, hi. So, sir, how much of the current order book is with the top 3 customers, and what is your single largest customer concentration?
Sorry?
Can you just repeat your question? There was some voice crack.
Yeah, sorry. So how much of your current order book is with the top 3 customers, and what is your single largest customer concentration?
Okay. So, as of now, for the closed orders, the single largest order is of 600 plus crore. That is the single largest order that we have closed. And the second highest is 175 crore, which we are now, we have already prepared document and agreed on just the signing is pending, which is backed by the LOI also, firm LOI. And the third order, which I have mentioned, is a 42 crore for the modules from the domestic captive projects. So these are the three orders which I have already mentioned in my commentary. And apart from that, we have one inquiry for almost about 2 gigawatts, but then we are, committing them almost about 400 megawatt in this financial year, and then the rest in the next financial year. And so these are the order size that we are working. Besides the something in range of 5 megawatt to 50 megawatt domestic orders, which are the captive orders.
So, Chetan bhai, throw a light on the orders we are completing till December. But if you see our order book, like the order book, what we are mentioning is of mix of clients. Secondly, at Solex, we have a lot of repetitive orders. But last year also on ongoing basis, we had an inquiry of almost 4,000 crores with us. And these were not just roving inquiries, but these inquiries were backed by their audits or the facilities. Our facilities already audited, but the delivery schedule and price mechanism was under discussion. So there is a complete flow of new orders, but since we have comfort with our existing customers, so it's vice versa. So we see repetitive orders.
Okay, sir. Understood. And sir, how is the EPC order book trending separately from the module order book, and what margin differential exists between the two?
EPC, as we have mentioned previously, EPC is not a major focus. So around 150 crores of business, what we target from the EPC business, and these are generally from the C&I segments. Generally ranging between 1 megawatt to 5 megawatt of orders and some rooftop of orders. So at Solex, our major business comes from IPP. So we don't want to look like a competitors for our customers. So at Solex, we have approach that we have to go very minimal. So we have a target of almost around 150 crores coming from the EPC business. And margin, I think so it's around 10 to 12%.
Okay, sir. Got it. One last question from my side. So, sir, the module capacity utilization for FY26 averaged around 70%. But your FY27 guidance is built on a more conservative 55% utilization assumption despite the incremental 2.5 gigawatts coming online. Why the more conservative assumption for the bigger base, sir?
So as the capacity has increased, previously we were operating with 1.5 gigawatt, and now we are at 4 gigawatt. So looking to the scale and everything, and if you see the average industry utilization, it is 50%. So plus, due to the disruption what has caused because of ALL and everything, so this year you can say it was a turbulent year for the industry because of the whether the ALL will be introduced, it will not be introduced. So a lot of people were wait and watch approach was there. And this is the reason we have been a little bit, conservative, and this is the what we have targeted for the current year.
There was a lot of focus on the domestic cell manufactured projects. So all of us know that there is a delay in capacity building for the cell. So basically, but the whole module manufacturing segment is dependent on, they were dependent on domestic cells, but which are not sufficiently available at this moment, and which are likely to be made available by within a year time. So there is a huge dependency on projects which are the grandfather projects, and which has created a lot of confusion. You have seen, from May, June and July, there was a lot of confusion, and now there is some clarity from the August, and then post-monsoon, it will cover up. So the capacity utilization, we are being very conservative, considering all these factors and, the loss of production that which we had, slowdown in the production which we had in those 2 months.
So that's it from my side. Thank you for the opportunity.
Thank you very much. Next question is from the line of Ashish Kolecha. Kindly announce your company name and proceed with your question.
Hi, sir.
Hello.
Sir, Ashish from B Ventures LLP. Sir, am I audible?
Yes, yes. Ashish, go ahead, please.
Sir, wanted to understand, like many of your peers, if you see, those who are coming into cell, be it Jupiter, be it Vari, or many others, you understand that, with respect to cell manufacturing, everyone has. I'm not pointing out to any particular player, but whatever 8 to 10 names are there in India, you would be knowing that they are facing decent problems with respect to execution issues, availability issues. And you also understand that it's not so easy compared to other streams and of the value chain when it comes to cell manufacturing. So wanted to understand that how are you going about this execution with respect to the availability factors and the flat power and water, and also wanted to understand whether your scope is for 5 gigawatt or 2 gigawatt. If you could throw some light on your plans with respect to cell manufacturing, that would be really great. Thank you.
Good question, Ashish. In fact, I'll just answer this, in part. The first is that the second question which you asked is whether it is a 2.2 gigawatt or 5 gigawatt. Our project is 5 gigawatt, which we are executing in 2 phases, that is 2.2 and the 3. So we will have a single site having 5 gigawatt of cell manufacturing. So, that is the answer to your second question. The first question, which is operational challenges, which you have mentioned correctly that India has a lot of challenges in terms of operations. There are, I'll just take a little deep dive on this question because, whatever the capacity currently available in India as far as the cell manufacturing is concerned, most of those capacities are the old technology, which is a monoPERC. So, and there are very few players operating with TOPCon lines. There is sizable capacity almost to the tune of 5 gigawatt, which is the proprietary technology. We can say it is HJT and thin film. So if you don't consider those proprietary technology, then we have only the monoPERC and the TOPCon available. In TOPCon also, the most of the capacities are majority, 80% of the capacities are manufacturing M10R cells. There are a couple of players only manufacturing G12 or G12R cells. So these are the breakup of the cell capacity which is available. As far as the technical challenges are concerned, there are 2 parts. One is the infrastructure, availability of infrastructure, which is the water and connection, which is fine. It takes its own time. It depends upon in which pocket you are putting up your plant. Gujarat being a very highly industrialized place, it has a little bit more challenge in time. But then when it comes to the operational part of it, the availability of this infrastructure, consistency of this infrastructure is concerned, which has, very good track record. And as far as the operating cell line is concerned, so once you have an infrastructure available, then the major challenge is the operating cell line because it is a quietly recipe driven and chemically driven the manufacturing. So it requires a lot of, and particularly TOPCon is more challenging than monoPERC. So understanding these challenges, because the other companies, those who have already installed and they are facing the ramp up challenges, they are trying by everything by their own or having a consultant on board with them, and so they are the first mover. So what we are doing is, understanding these challenges. The ISC constants is there, which we have collaborated. We have brought them on a board. And as you heard in my commentary, that we have a very professional cell manufacturer coming, to operate these lines. And it's not only operate the line, they are involved into right from the phase of designing, the construction, and the operational part. So basically, these challenges are only with India. Currently, the Chinese manufacturers are not facing these challenges, operational challenges, because they already have a deep experience, and they're producing very high efficiency cells. So we are bringing them on board to deliver the similar outputs with our cell line. So, just to overcome the limitation of manpower, knowing, custom cell, we are bringing the experts here. So this is a different strategy that we are working with Ajit. Thank you.
So Ashish, as Chandra said, you have rightly observed the main core issues of the cell manufacturing. And at Solex, as Chandra mentioned, that though we are slow and what we have targeted, but we don't want to lose on these two fronts. So we have seen people struggling with water, like almost 150 to 100 tankers being delivered daily for water. Power, people have to upgrade, and a lot of problems they have faced. So arranging an infrastructure in Gujarat takes time, but what we are ensuring that these hurdles we don't face these hurdles. And same thing we have solved with the technological partner. Thank you. Thank you.
Ashish, do you have any follow-up question?
No, sir. Thank you. Thank you so much.
Thank you very much. Next question is from the line of Krunal Patel, individual investor. Please go ahead.
Hello, sir. Good morning. Sir, some independent power producers are waiting for DISCOM's approvals because grid stability is not ready. Sir, is this real scenario?
In Gujarat, yes, there is a situation, majorly because, a lot of generation which is happening in Gujarat and, it is to be consumed in Gujarat. And that's the reason there is some load curtailment issue is going on. And then there are connectivity challenges are also going in some part of the country, not everywhere. So, and these are temporary, these are the challenges. And once this national green grid from the Khavda and other grid lines are operational, which are on a very fast track, these challenges also will get resolved. And the way the BESS is coming up, so again, that will be one of our major, move to solve this grid stability issue. So I think it's just a temporary. In few months, it will get resolved.
Okay, sir. Sir, till end of FY27.
Sir, I'll again additionally share that why we ended up into this situation. In FY25, India did 25 gigawatt of solar installation, and then in FY26 we ended up with almost about 50 gigawatt of solar. So the sudden surge in solar generation, and particularly in a very concentrated pocket of Western India, that has brought put everybody into this situation. But now the other states are also very aggressively coming up with their own projects, so that and in the Gujarat, the western part of this country is aggressively working on the grid, additional grid availability, national grid availability, and BESS. So this will move will change the situation.
Okay, sir. Till end of FY27, India's top one cell capacity will be more than 70 to 80 gigawatt because all underlying cell capacity will be executed. But sir, price will be equivalent to imported Chinese cells for existing module manufacturer?
No, it will be higher. And those tenders which are already bidded with the domestic cells are bidded with the higher price, considering the high cost of cells. So the Indian cell cost will be higher, compared to the imported right now.
But till that time, nobody will be allowed to import. So the price, the cell available will be of the same price in the entire market. So as such, it will not impact any module manufacturer because all the price will be same for all.
So existing only module manufacturers can be survive in this market because the module for module manufacturers cell price will be higher, as you say.
Yeah, so I don't see any very big challenge in terms of survival for the standalone module manufacturer, because the way the market is growing, and then the the retail, the captive market is also growing so fast, the small rooftops and the industrial and commercial and then the residential rooftop. These are the segments where this standalone module manufacturer will be able to, grab business. But yes, there will be some consolidation which might happen in days to come, and which is for good, basically, because remaining small and with a limited capacity will always be a challenge. Both things will happen. One is that there won't be any major challenge for the survival, existence of a standalone. And number two, because of there will be a lot of cell capacity will be available. And it's not that those who are having cell having only business. There are people having their own connects in the market and they are able to grab the business and then they will procure cell from the existing cell manufacturer. Number two, the MNR is also very sensitive about this, about the availability of the merchant cell, in the market. So they are also continuously in discussion with those cell manufacturers to make the cell available for the standalone module manufacturer. And post that, there will be some consolidation. Those who are not fit, those who are unable to execute, and they will get merged with some other existing players. So this market shift will definitely happen.
Plus, if you see, there are certain units which are only cell manufacturing. They don't have a module manufacturing capacity. So a lot of capacities are coming whereby they are not into module manufacturing and they are directly starting cell manufacturing. So I think they'll also bridge this gap.
Okay. So this will be happen because direct some module manufacturer is not adding their solar module manufacturing line, but they also adding more cell manufacturing line. Even new players will do the same. So sir, this for independent power producer, sir, they are waiting for DISCOM's approvals as we discussed that grid instability will be solved in upcoming months or years. But in this upcoming excessive daytime solar power will be converted into this green ammonia because BESS lines are not currently fully operationalized because there are projects our cost is comparatively higher because this BESS is added by MNRE. So is this ammonia market is option in near future for this excessive solar power due to instability of grid and over project price of BESS project?
So the ammonia, the hydrogen, everything is basically, it's catching up. It will, because, these are like, a little bit complex in terms of manufacturing. It will take its own time. Then commercial viability is also like, that India considers the most. So, these are the things which are in pipeline. Will take its own time. I think the BESS will come so fast because it is established technology and commercially also it is viable. So I think India will go very fast in terms of BESS and then followed by the other source of renewable energy. But yes, all the source of renewable energy apart from the BESS and then ammonia and the hydrogen, solar will be the main source of energy for them to produce whatever that they are meant for. So the solar has a very bright future and it has a very long term also. Apart from that, there will be a lot of technology shift which has already happened. So there will be there are projects which will go for the repowering and they will replace their old outdated modules from their projects with the new one, which are the top one technology. So there will be constant some movement for the module in India and the overseas market will continue.
Thank you. Krunal, I'll request to come back for a follow-up question.
Okay, sir. This is my last question, sir.
Thank you very much. Next question is from the line of Jitendra Rathod. Kindly announce your company name and proceed with your question.
Hello, Jitendra.
Jitendra, can you hear us? Yeah, go ahead.
My question was regarding the distribution strength that currently you have.
I would like to know more about that, sir.
Sorry, can you please repeat the question?
Strength that you have currently, and what distribution?
Jitendra, sorry to interrupt you. Can you please speak closer to the phone?
So my question is regarding the distribution strength that you have right now. I would like to know more about that.
Okay. So you are referring to our sales distribution channel, right?
Yeah. What is the go-to-market strategy on all?
Okay. So, right. Basically, we are majorly focused on the IPP business. So most of the customers are the large-scale IPP power producers. So basically, where we interact with them directly without having any channel in between. And so that is the majority of business. The second, the largest business is coming from the C&I segment, which is again, captive, more like a utility scale or the large scale rooftop, where also our sales team, we interact directly to the client. So as such, we have not developed any distribution because since we don't focus on a retail segment majorly on a residential rooftop and those where there is a requirement for the distribution channel. Our focus area is different, so we have not concentrated more on developing the distribution channel and go-to-market kind of strategy. We are already present in this market for. So as I said, our major focus will remain on IPP and utility scale. So immediately in near future, we don't have any aggressive plan to come into the distribution since we are not focusing on that segment. Once we have our cell line up and running, and then based on that, maybe post 2028, we will give it a thought on this.
Thank you, sir. Thank you.
Thank you very much. As there are no further questions, I will now hand the conference over to Dr. Chetan Shah for closing comments.
So thank you, friends, for your questions and understanding about the industry and about the Solex. I just want to mention that renewable energy, particularly solar, is not quarter-to-quarter business. And, so this is what we have seen for more than 2 decades, that H2 is, there is a very huge moment in terms of revenue, in terms of delivery, shipment, and the books also, whatever that balance sheet or P&L that you see, which we focus majorly onto the H2, because H1, irrespective of any efforts, that you have a lot of challenges that we have seen, majorly this climatic challenges. And this year we had some policy, moment which happened, and because of that also there was some disruption. Industry is growing very fast, so the challenges are also because this is one of the fastest growing industry. So have patience, keep faith in the company which you have already kept in. Now we are available on NSE and BSE both. So, we foresee a lot of visibility and flexibility, with that as well. And whatever that expansion plan that we have, it is time driven. So once we announce something, we will have a more clear, idea about whatever. And we've been very conservative in producing and giving a guidance in terms of numbers. Last year performance also that you see that, H1 and H2 difference, and this year also we are likely to do that. So thank you, Matt. Thank you very much. And I think anything in future that comes up, we are always available to answer. Thank you.
Thank you.
Thank you very much. On behalf of Solex Energy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.